Hi, my name is Billy Flowers, and welcome to my channel where I talk about velocity banking and how we can use this strategy to massively pay off debt. So, in today's video, we're going to be talking about how to bank traditionally versus how to bank the velocity banking way using a line of credit. So, we're going to be starting on the traditional way. How this works is we get our check. It's either direct deposit or if we're still old school and get that paper check, either way, it's going to get deposited into our checking account. And then we're going to have bills that get paid. And then what's going to happen? We either have these bills automatically come out of our checking or we pay them manually. Either way, the bills get paid. And then whatever is left over, we have that money go into our savings account. Now, the thing is when we have our money in our savings account, what is it actually doing? Especially in these big banks. Are you getting this big, huge lump sum or this big, huge interest rate on your money that's in the savings account? No, you're not. Especially for these big banks, you're getting this little tiny bit of interest, maybe 0.1%, 0.01%. They're barely giving you any interest for the money, for your hard-earned money that you work for, and keeping it in their bank. This the privilege of it, you opening your account and just looking at some numbers. And what they're doing is they're taking that same money and they're lending it out. They're lending it out maybe on a mortgage, right? On a mortgage, charging you maybe 5 or 6% on a mortgage, right? And and the way these amortized loans are is they front load all the interest, so they're getting all that interest back, right? At the beginning of the loan, and and probably all the way until halfway to the loan, and towards the end of the loan, that's when you actually start paying down these amortized loans. In the meantime, you're just getting a little minuscule of this little, they'll give you like a 0.1% APR on the little money that you have in your savings account. At the same time, they're collecting all of that interest. You're buying the bank, you end up buying a bank a house, an extra house on top of the house that you bought. So you got a house and the bank got a house. That's how this works. That's how they make their money. See, us velocity bankers, we're smarter than that. We're going to introduce a line of credit into the equation, and we're going to leverage other people's money and pay less interest at the same time as paying off a debt. So let's see how this works. So same deal. We're going to get our check. It's going to go into our checking account. And once we have our line of credit, we're going to use, let's just say this is $10,000 and we have a debt to pay. So say it's a credit card, a student loan, a personal loan, or even a car. We're going to take $10,000 and put it on one of those debts. And soon as we get paid, that day, soon as we wake up in the morning before your eyes even open, you're going to log into your bank account and you're going to immediately transfer your check into the line of credit. And what that's going to do is it's going to lower the balance. You had 10K. Let's just say, for instance, you got paid and your check was 2,500. You're going to immediately put that 2,500 into the line of credit, and that's going to lower the balance. And a lower balance means less interest that's going to get charged. Because on a line of credit, interest is charged on the ending daily balance every single day. So the lower that you keep the balance, the lower the interest that you're going to get charged. That's the beauty of this concept. And at the same time, you didn't pay down a debt for $10,000. But on this end, you're barely paying any interest because you're dumping all of your income into the line. And then when it's time to pay your bills, what are you going to do? You're going to take the same money that you put in, you're going to take it out and put it into your checking account. And then you're going to pay your bills. And the thing about this is, if you have a budget and you have cash flow, the money that you're putting in is going to be, it should be more than what you're taking out. And what's left over is your cash flow. So say for instance that you have $2,000 of cash flow, your income is 5,000 and your expenses is 3,000, you have $2,000 left over every single month. That's what's going to pay down the balance every single month. And now you may be asking yourself, well, am I still going to have a savings account? No, you're not. Why would you have a savings account if you have debt out there, like say for instance a credit card that you're getting charged 25% interest on, and you're just paying the minimum monthly balance on it? What is that doing? You're getting charged 25% every single month, and yet you're keeping your money in a savings account where you're earning 0.1%. And you might even have this in one of those high yield savings account where you're earning 4 or 5% APR, but even then, you're still getting charged 25% APR on your credit card. Or you have one of these amortized loans out where it says 6% on a loan, but you're probably paying over 30% or more if it's the beginning of the loan of interest. Yeah, that's how these loans work. So what we're going to do is we're not going to put any money in our savings. Our line of credit becomes our checking and our savings. And the way that works is, like I said before, if we put out $10,000 and our income is $5,000 and our expenses are $3,000, that first month our balance is going to go down to $8,000. That means that we have $2,000 left over just in case an emergency happens for that first month. And then the second month, we're going to repeat the same thing. $8,000 is your balance. You're going to put 5 in, right? You're going to take 3 out, and now your balance is $6,000. And then the month after that is $4,000. And then the month after that is $2,000. You see where I'm going with this? That means that you're going to have every single month, you're going to have that much more room, that much more savings, just in case something happens. But at the same time, you're paying down your debt, this high interest debt that we're all in. So this is the velocity banking way, the more efficient way that you use and you leverage your money to pay off debt. That's the whole point of this strategy. Instead of just putting a little bit of a little bit of money, extra money on your credit card. You're putting an extra 20 on it, or extra 5 on it, or maybe an extra 100 on it. No, we're chunking at these debts. We're putting hundreds, if not thousands, of dollars onto these debts, and that's going to massively pay them down. You might even pay debts off with this $10,000 chunk, and all of that monthly payment is coming back to you, and that turns into cash flow, which is going to help pay down this debt even faster. So this is the traditional way, and this is the velocity banking way. I know which way I'm going to pick. What about you? So I want to thank you for watching this video today, and don't forget to like, subscribe, and comment below. And like I always say, get that cash flow.